Why do some people stay calm in a crisis while others panic? This secret isn't a high income, it's solid financial principles. No luck, just discipline. This video reveals 8 money rules, starting with the most crucial one that have helped millions of middle-aged Americans stay stable in any market. From automating investments to avoiding bad debt, these are the exact principles that build true financial freedom without fear.
Principle 1. Automate your finances. Build wealth in silence. For busy middle-aged individuals, managing personal finances can feel like a relentless chore, often pushed aside in the rush of daily life. The simple yet profound solution to this challenge is financial automation. It replaces unreliable willpower and emotional decision-making with a systematic approach that builds wealth consistently, even when you're not paying attention. At its core, financial automation is the practice of setting up recurring transfers to manage your income. As soon as a paycheck arrives, scheduled transfers can automatically direct funds towards savings, investments like a Roth IRA or an S&P 500 ETF, and debt repayment. This system transforms wealth building from a series of monthly chores into a seamless background process. It removes the risk of impulsive spending or delayed saving, ensuring your financial goals are met with machine-like precision. The true power of this approach lies in its consistency. A modest, automated investment of $500 per month can grow to over $85,000 in a decade, assuming a 7% annual return, all achieved without any manual intervention beyond the initial setup. Wealth is rarely built in a single dramatic move. It is forged through disciplined, repeated actions. Automation ensures these crucial actions happen every single month, harnessing the immense power of compound interest over time. For those over 35, time is the most valuable asset, and the window for correcting financial mistakes narrows. As responsibilities multiply, relying on sheer willpower to save and invest becomes an increasingly unreliable strategy. Automation provides a critical advantage, making your financial success dependent on a smart system, not on daily discipline. You don't have to be the most knowledgeable investor, just the most systematized. Ultimately, automation is not a shortcut, but a foundational principle of modern wealth creation. It allows you to make one intelligent decision up front that pays dividends for years, freeing up your time and mental energy for what truly matters. Instead of being a source of constant effort and anxiety, your finances become a well-oiled machine working silently to secure your future. It's the most effective way to ensure your financial future is built on precision and discipline, not chance.
Principle 2. Think long-term. Don't fall for get-rich-quick traps. In a financial landscape filled with the siren call of instant wealth, from 100 times coins to overnight stock windfalls, the most crucial principle for sustainable success is also the most understated. Think long-term. This disciplined approach is the antidote to the speculative fever that has financially ruined countless individuals, especially those in middle age who lack the decades needed to recover from catastrophic losses. Adopting a long-term mindset fundamentally changes your behavior as an investor. It frees you from the emotional trap of FOMO, fear of missing out, which drives people into speculative bubbles just as they are about to burst. Instead of chasing volatile trends, you commit to consistent contributions into proven, reliable vehicles like broad market ETFs, S&P 500 index funds, and tax-advantaged retirement accounts. History consistently shows that investors who steadily contribute over 15-20 years far outperform those who jump in and out of the market attempting to time the wave. This discipline fosters profound mental resilience. When markets inevitably fluctuate or crash, the long-term investor remains calm. They understand that downturns are a natural part of the economic cycle, and for those with a long horizon, represent buying opportunities, not catastrophes. While short-term speculators are panic selling at the bottom, disciplined investors are sticking to their plan, quietly accumulating assets at a discount. This protects not only their capital, but also their peace of mind. Ultimately, long-term wealth creation transcends personal retirement. It is about building a lasting foundation of security that can serve future generations. By focusing on steady, sustainable growth, you are not just accumulating money, you are cultivating a legacy of financial wisdom and discipline to pass on to your family. Therefore, reject the seductive promises of instant riches. True wealth is not an event, it is a process. It is not born from a lucky break or a once-in-a-lifetime tip, but from the cumulative power of sound, disciplined choices repeated over decades. This patient, smarter path is the only reliable road to genuine and lasting financial freedom.
Principle 3. Invest in yourself because you are your greatest asset. In every economic downturn, there's one asset that can't be stolen, taxed, or devalued over time: your knowledge and skills. Most people think investing is all about stocks, real estate, or retirement accounts. But in reality, the highest return, most reliable investment you'll ever make is in yourself. Continuously learning, sharpening your skills, and expanding your understanding of personal finance, technology, and the job market isn't just wise, it's essential if you want to not just survive, but thrive in a constantly changing world. When you invest in yourself, you significantly increase your earning potential. Someone with strong financial literacy doesn't fall for too-good-to-be-true investments. Someone tech-savvy won't be left behind as automation and AI reshape the job market. And someone who understands market trends will always be ahead of the curve, even in crisis. Self-investment also gives you better control over your financial decisions. You stop making choices based on fear or ignorance and instead learn to assess risks, choose the right investments, and maximize the value of every dollar you earn. By your 40s and 50s, investing in yourself is no longer optional. It's critical. This is when the pressure mounts, the job market becomes more competitive, healthcare costs rise, and retirement looms closer. If you're not growing, you're falling behind and losing your grip on your financial future. On the other hand, those who keep learning, who build new skills, and who adopt a financially intelligent mindset don't just hold on to their careers longer, they manage their money smarter. They know which expenses are essential, which are wasteful, and which decisions build long-term wealth. Don't focus solely on making money quickly. Become someone who deserves wealth. Because when you commit to personal growth, your finances tend to grow right alongside you. And that's something no one can ever take away.
Principle 4. Always have an emergency fund, because life is unpredictable. Life rarely goes according to plan. One accident, sudden job loss, a medical emergency, or an economic downturn can hit without warning. And in those moments, the one thing that keeps you afloat isn't a high income or smart investments, it's a solid emergency fund. This is one of the most overlooked financial principles. Set aside at least 3 to 6 months' worth of living expenses in a separate emergency savings account, something safe, liquid, and completely separate from your long-term investments. This money isn't meant to grow, it's meant to protect. Think of it like a financial life jacket. You may not need it every day, but when you do, it's priceless. An emergency fund means you won't have to sell assets in a down market, rack up high-interest debt, or borrow money from family. This becomes even more critical in midlife, when you're juggling a mortgage, children, health issues, and retirement planning. Imagine losing your job in a recession. Without emergency savings, you may be forced to withdraw from your retirement accounts, paying steep penalties, or worse, sell investments at a loss. But with a strong emergency fund in place, you buy yourself time, you stay in control, you avoid panic-driven decisions. There's no greater peace of mind than knowing that no matter what happens, you can still put food on the table, keep a roof over your head, and stay on track financially. An emergency fund won't make you rich, but it will keep you from going broke when life throws you a curveball. Life is unpredictable, but you can prepare.
And building a solid emergency fund is one of the simplest, most powerful things you can do to protect yourself. Because people with a plan always outperform those relying on luck.
Principle 5. Protect your wealth. Don't lose it all because you didn't plan. Many people spend a lifetime working hard, saving diligently, and slowly building real wealth. But here's the harsh truth. All of that can be wiped out in weeks by one unexpected event, an accident, a major illness, or an untimely death, if you don't have the right protection in place. That's why protecting your wealth is not optional, it's essential. And it goes far beyond keeping your money in a bank account. Real protection comes from systems: life insurance, health insurance, property insurance, liability coverage, and a legally sound will. These forms of insurance are your financial defense system. A medical emergency without insurance could cost hundreds of thousands of dollars. A car accident you cause without liability coverage could cost you your home. And if you pass away without a will, your family may be dragged through years of expensive legal battles, stress, and unresolved conflict. Insurance isn't just another bill, it's an investment in peace of mind. You hope you never need it, but you'll be thankful you have it when the storm hits. It's like carrying an umbrella on a sunny day. You don't think you'll need it until you really, really do. And writing a clear, legal will is one of the quietest, most powerful acts of love you can leave your family. It ensures your hard-earned assets are passed on to the right people in the right way, without drama, confusion, or legal chaos. In your 40s, 50s, and beyond, you've likely accumulated significant assets. You have a family depending on you. Your children's future matters more than ever. At this stage, protecting your wealth isn't a choice, it's a responsibility. You can't control what life throws your way, but you can prepare. And preparation is the mark of a financially mature, responsible, and truly wealthy individual. Building wealth is only half the journey. Keeping it and protecting the people you love from financial devastation is the part that truly matters. Principle 6. Invest in index funds and ETFs. When most people think about investing, they imagine high-stress days glued to charts, constantly guessing which stock might break out next. But in reality, the most effective investment strategy is often the simplest one: regularly investing in index funds and ETFs. Funds like the S&P 500, Total Market Index, or sector-based ETFs offer a straightforward path to long-term growth. You don't need to be a financial expert or spend hours analyzing individual companies. All you need is a consistent habit. Set up an automatic monthly transfer and let time and the market do the heavy lifting. The strength of index funds lies in their low costs and diversified risk. Instead of betting on a few volatile stocks, you're investing in hundreds of companies, big and small, packaged into one fund. That means if a few companies stumble, the others can balance out or even continue growing, keeping your portfolio on a steady upward path. Index funds also help you escape the stress of timing the market, a nearly impossible task, even for professionals. By investing a fixed amount each month, you naturally apply a strategy called dollar cost averaging, minimizing risk and optimizing long-term returns. What's the best part? Your wealth can continue to grow quietly in the background while you live your life, traveling, spending time with family, or even retiring early. You're no longer caught in emotional market swings. Instead, you're investing with peace of mind, consistently, patiently, and powerfully. Multiple studies show that individual investors who simply buy and hold index funds like the S&P 500 often outperform those who constantly buy, sell, or chase trends. In the long game of wealth building, discipline and simplicity almost always beat complexity and noise. If you're looking for a stress-free way to build wealth without gambling, without guesswork, index funds and ETFs might just be your best bet. Because in personal finance, the quiet and consistent path is often the one that leads to lasting prosperity. Principle 7. The earlier you invest, the sooner you gain financial freedom. If there's one rule most wealthy people follow without exception, it's this: start investing as early as possible. Not because they have special stock-picking skills or large sums of money, but because they understand the magic of compound interest, what Albert Einstein famously called the eighth wonder of the world. Compound interest isn't just earning interest on your money, it's earning interest on your interest year after year. It's a snowball effect where small amounts, given enough time, grow into something massive. But the key ingredient is time, and that's why early investing is so powerful. Even modest, regular investments in your 30s or 40s can grow exponentially over the decades. Wait too long, and you'll need to invest 2 or 3 times as much just to catch up. Investing early also lifts a huge burden later in life. While many people work into their 70s just to stay afloat, early investors are more likely to retire early, live on their own terms, and focus on what truly matters: family, health, and personal passions. And if you feel like you don't have much to invest, that's okay. What matters most is starting the habit. Even $20 or $30 a week, consistently invested, can become a sizable nest egg over time. It's like planting a seed. You won't see the tree tomorrow, but stay consistent, and one day it will provide shade, fruit, and security for years to come. If you're in your 40s or 50s and thinking, it's too late, think again. Today is the second best time to start. The best was yesterday. And by starting now, you give yourself a real chance at financial freedom, control, and peace of mind in retirement. Investing isn't just for the rich. It's how many people become rich. And it's not about how much you invest. It's about when you start. The earlier you plant the seed, the sooner you'll harvest the rewards.
Principle 8. Avoid bad debt. Only use debt to make you richer. Debt isn't inherently bad. In fact, many wealthy individuals use debt as a strategic tool to invest, to buy property, to expand their assets. But the key is this: debt only helps if it makes you richer. That's the difference between good debt and bad debt. Bad debt is money borrowed for short-term consumption, often with high interest and no lasting value. The most common example? Credit card debt, with interest rates of 20 to 25% a year, all for a few impulsive purchases, or car loans and consumer debt for items that quickly lose value. When you rely on debt for everyday spending, you're not just draining your monthly income, you're also damaging your credit score, which in the U.S. is like a financial passport. A poor credit score can block you from buying a home, investing, or even getting a job. But when you avoid bad debt, you're building a rock-solid financial foundation. You preserve your credit score, save on wasteful interest payments, and stay ready for meaningful opportunities, like buying real estate or launching a business with access to better loan terms and lower risk. Remember this: debt doesn't make you poor. Misusing debt does. Borrowing to invest in income-generating or appreciating assets, like rental property or a long-term fund, can be a smart move. But borrowing to fund a lifestyle beyond your means will keep you in a cycle of stress, no matter your income level. Use debt wisely. Let it work for you, not against you. Only borrow when it increases your net worth, improves cash flow, or opens a door to real opportunity. Otherwise, live below your means, pay in full, and protect your future from unnecessary burdens. That's the path to real financial freedom. Wealth isn't about genius, it's about discipline. You now have the proven principles that have helped millions find financial freedom. The smallest changes you apply today will create massive differences in your future. If you're ready to act, like, share, and subscribe for more insights. Don't wait for luck. Your journey to lasting financial security starts with the actions you take right now.